Well, Justin, we're back for another episode here. We're going to start off a little different though, because it's early in the morning, and as much as I love wine, I don't know about popping a bottle at 8 a.m. So we did have the idea for bubbles. Would have been a good idea, but
someday
didn't bring that in. So we're going to go with some coffee today for everybody. Another, I would say, not quite a second passion of ours, but we certainly like our coffee around here. So we've got some Verve coffee roasters in the cup here, specifically El Mason, little key lime, meringue, honeysuckle, little ode to Santa Cruz, your stomping grounds for college. And I've got family there. So it's a subscription I get every couple of weeks, and I love starting the day with it. So visit Verve Coffee Roasters if you like coffee. I don't think you'll be disappointed. But let's hop in here, Justin. Why like I mentioned, we're recording this a little bit early in the week, early in the day, and it's because you're hopping a plane and you're headed to San Francisco. So I'd love for you to just hit on what's taken up there and why it's important for you to get out of the office for a couple of days to head up there.
Sure. Yeah. Looking forward to it. A couple of reasons. And always try and make the most of our time up there. But first and foremost, one of the venture funds we're invested in, Magnify, has their annual meeting later today, actually. So typically for most venture firms, they'll host an annual meeting, go over the portfolio, what they're seeing, whatnot. So I think, and what we're going to get into a lot right now today, it's timely. Markets have been very, very interesting, both in the public markets and as well in the private markets and venture specifically. So really looking forward to that update. And then sticking with venture, tomorrow there's a conference called the Raise Global Conference, which is focused on emerging managers. I was on the selection committee. It was an interesting experience. I mean, 400, 500 funds applied. It was a pretty rigorous process, and to get to be invited to the conference, it whittled down quite a bit to 20 funds out of that 500. Shows you people are still trying to raise money. People are still starting companies. There still is a lot of innovation going on, but there's more and more competition within ventures. So it's an interesting dynamic that's going on that will continue over the next, who knows, 12, 24 months within the private markets. Yeah, and totally. Looking forward to it.
It'll be fascinating to hear the updates, and maybe we can give some of the updates on Insights next week. But it's going to be fascinating because, as we know, the private markets still make up the vast majority of the investment markets, right? Like, I think we've got a graphic we use with a lot of people, it's the iceberg. Like, actually, most of the investments, right, the private investments, are below the surface, right? Where you don't typically see them, but it's the bigger part of the iceberg. And the tip is really only the public markets that most of us pay attention to. And there's no shortage of news out there right now that's certainly causing such interesting times in the public markets and bleeds through the private markets. So it'll be a pretty interesting update. And the last week, month, year, frankly, has been just fascinating,
interesting,
to say the least. And, we talked about this a little bit last week, but, for clients listening, we feel this pain because our portfolios our money's invested the exact same way that our clients are, and we're in this with them. So to see the S&P 500, for instance, be down 23% year to date, we're in the heart of a bear market here. That pain definitely stings a little bit. And so we'll go through some of the things that certainly get us comfortable looking at our portfolios and seeing them down at this point in time. But, one fascinating stat I heard on a podcast on the way in this morning was, S&P is down 23%, but that 23% is actually created by 9 days this year. So
amazing,
which is crazy when you start to think about it. There's 254 days, trading days in a market year. We're probably about 200 days in. So we're talking about 9 out of 200 days. Pretty fascinating. If you just take those 9 days out, which, God bless you if you could figure out a way to do that. I don't even think you could implement that even if you had the crystal ball. But let's say you could. If you're able to remove those 9 days, kind of a silly stat, but you'd actually be up 9% year to date in the S&P 500. So just pretty fascinating. I think we talked about it last week.
Yeah, exactly.
The opposite effect of this. If you miss the best days, what's it do to your return? I think it was over 30 years if you miss the 50 best days or something like that. basically wiped out your return, which was pretty monumental. So just kind of going back, like trying to time these things. I mean, the margin of error is so small to just dramatically impact your investor experience over time.
And I think the conclusion that I would try and impart on everyone from both of those statistics is the downside to being wrong if you're trying to time the market or predict the future. We all know it's very, very difficult, if not impossible, but just take a step back. Even if you say, hey, there's a small probability I can be right, the downside of being wrong is substantial. I mean, that's what these show you, right? The 50 missed days wiping out your entire return over a 30-year period. I mean, that's painful. And then, and that puts your priorities, your goals at risk, which take the investment return out of it. That's what's important. Now, investment returns drive your ability to do that. But think about that. If you can't actually do your goals, you can't actually live this life that you've kind of envisioned for yourself because of silly decisions that are not supported by the data. I mean, it really just, it's a strong argument in my opinion, and obviously why we do what we do, but it's a strong argument just to not play that game.
Totally. Well, and it's natural, right? You hear, oh, I want to participate broadly, diversified portfolio, et cetera. It kind of sounds boring. Well, what about this new star manager that's just totally blown it out of the water? I mean, Cathie Wood, for instance, ARK, that gained all the headlines last year. I mean, she was up over 700% in early 2021 over the S&P 500. I mean, looked like the can't miss person. I mean, money flowing in, the hype beyond all hype, and it's taken a quick turn. She is now underperforming the S&P 500 in less than 2 years, and just completely incinerated the wealth of tons of people. What's fascinating is people still are just piling into her fund. Well, Cathie, I apologize. I think she just cut off her audio. Somehow she's got to tap into it and got really pissed off at that. But Cathie, it's not against you. It's against all active managers. To be clear, we just don't believe that anybody has the foresight to really make these moves. So I'll move on from Cathie here at the risk of her just killing our audio again, and we'll move on. But, I think to go pick on somebody else, I think picking individual companies to invest in and really trying to figure out it's just a hard game. I saw another quick anecdote was that Blockbuster Video actually opened on this day in 1985. So I think most of the people listening, most of our clients here know what Blockbuster is, but you're a young crowd, so maybe not. So this may land flat, but fascinating for me nonetheless. Opened in 1985 with one store, actually got to 6,500 stores by 2010. I mean, in 2010, when there were 6,500 stores, people thought, this is the future. They're the clear market dominator. They had a meeting with Netflix and the owners there to actually acquire them and save them from going bankrupt. And man, what does time turn today, 2022? There's one Blockbuster store, and I think it's an Airbnb. You can actually rent it. You could probably pop a VHS in, maybe play some Duck Hunt, but pretty fascinating. And Netflix, on the other hand, has got 223 million subscribers. So I think it's really hard over periods of time. And that's just one example. We see in the data time and time again, it's virtually impossible to go pick these companies that are going to win over the long term. So it is just a much better approach to go find that, that reliable, based on the data place that we can expect higher expected returns.
Yeah. I mean, this is a great example of creative destruction is I think the technical term, but there are so many companies that go bankrupt, delist, get acquired. There's this just dynamism that happens within economies. And this is a great anecdotal example of it. And it's going to happen again. And guess what? I bet you one of the big tech titans today is going to be the next Blockbuster, so to speak, maybe a couple of them. And that's just what happens, and predicting that ahead of time, very, very difficult game to play. And like I said earlier, playing that game puts your goals at risk, as opposed to building something that's a lot more predictable. The term I like to use is robust, where we have a high level of confidence that this plan supports your goals. And, I think we're going to get into that from a structural standpoint a little bit.
Yeah, no, shoot, it could be Clipper Vision, right? Did you see that? Clipper Vision, they're launching their own streaming service. You can watch, every game for the entire season, $199 a year.
Everyone's getting into them.
Everybody's getting in the game. So who's going to be the winner? But I think you bring up a really good point here, Justin, is, we talked about this, but our portfolios personally are built the same way that our clients are listening to this, in the sense of we're implemented the same way. We have the same positions, but we have completely different allocations because our priorities are different. And, I think one thing we might not do the best job of explaining to clients is the role of bonds in their portfolio, because as we come up in this industry, you're always taught, okay, the bonds are the ballast to your portfolio. When equities get crushed, your bonds are going to help you out. They're going to keep the portfolio alive. And generally that does hold weight, but that's not why we do it, right? We do it for a different reason. I think you could even walk through an example, for clients listening. They're in a year where, we're actually doing some tax planning. They're going to have a tax liability due come tax time. Why? Maybe explain for them, if you can, why that bond that we buy, we don't really care what happens to the price, at the end of the day.
It's a perfect little microcosm of how we structure portfolios. We structure portfolios to meet your priorities or your liabilities, or whatever term you want to use, your goals, your cash flow needs. A tax payment in April is a perfect example of that. We know through planning ahead of time, hey, here's what your estimated tax payment's going to be. Instead of paying that upfront to the government, we're going to keep that in your bank account, earn a little bit of interest instead of the government earning interest on you. Right? That's a slight aside, but we're going to buy a bond that matches a maturity perfectly to when you need that cash. So, let's a couple days before April 15th next year, that bond will mature. And we're not going to take substantial risk with that bond because that's a very important payment to make. And so it's going to be a U.S. Treasury. Luckily now, we're actually getting a decent amount of interest on those treasuries, on those positions. But between now or whenever we took that cash and put it into a bond, the price doesn't really matter because we have a very confident outcome coming to us in April of next year. The government is going to come due or going to be good on their money and make that payment. When it comes to maturity, that the principal of that is owed. It hits the account and then we make the payment. So that's how we're customizing portfolios, right? It gets a little bit more complicated on that depending on how we classify priorities, the timing of it. You think very long-term, more, hey, discretionary, it would be nice to have type things. Those are perfect goals over 20, 30, 40 year periods of time to match up with public equities or venture capital, private equity in general. But that's how we build this. We use the term financial structure, your portfolio, a custom tailor-made portfolio. We build it based on all these priorities as opposed to a typical 60-40, which not a bad solution, but for our clients, for you all listening, it's not as robust. It's not as confident, really, in our opinion, way of going about it, as opposed to doing something very custom, tailor-made to you and your cash needs over time.
I think it's a great explanation. I mean, to put tangibility to it even a little bit, I have a priority personally at the end of next year that I know is coming, right? Yep. So I have money set aside. We bought a bond, and at the time we bought it, I think is probably paying around 2% interest, right? And let's say it was a $100 bond to keep things simple. If I look at my account today, that $100 bond is probably worth like $80. I don't know. Yeah. So that's not that much. Yeah. Okay. $90. Still, let's say 10% down, right? Like I could sit there and start to stress out about that, or I understand that, I don't really care about that because I'm going to clip this 2%. And next year, when I have that liability come due, I'm going to still have that $100 to make that payment. Exactly. I think that's the interesting thing to just wrap your head around and understanding what is the role here. And that's how we look at bonds in the portfolio. So hopefully people start to grasp that a little bit.
Yeah. And going back, the way a 60-40 portfolio typically operates, that's a good solution, like I said. But if it's not taking into account your unique situation, there is a chance that it's not the best solution for you. Totally. There's a very good chance because you're holding bonds that don't align with your priorities, or when your cash flow needs come about, right? And so there is a better way, which is why we do what we do.
Yeah. So I think, a good zinger, as we like to end these things, is a good zinger for you as you're talking to your friends, teammates, etc., family, especially with the off season starting here for the baseball player clients that are listening, is just really explain the bond side. You're not using this as something to kind of buoy the ship, right? Like, what you're really using it for are your priorities, and we're working through those priorities with you. So this is why we put so much importance on these priorities when we talk to you guys, clients, and we're going to kind of redouble down here, as we go through annual meetings, et cetera, is make sure we really understand those so we can have the right allocations to provide for those priorities. So the zinger is, ask people, hey, do you know what your priorities are? Do you know why you have a specific dollar amount of bond allocation in your portfolio? And if they don't, then they probably don't have one of these tailored custom approach. So as you know, we've got a text line for this that you guys can text into. Would love to hear from you. The number is 602-704-5574. We'd just love to hear if this resonates, if it helps explain a little bit more how we actually put together everybody's portfolios, or if there's anything that you want us to cover in the future. So until next time, own your wealth, make an impact, and always be a pro.
The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final